Wagner BIS Commodities, taking a look at the commodity markets here for the week. And let's just start out taking a look at where we closed for the week. Let's start out in the grain markets. We've seen corn close up 14 cents on the week at $3.18, almost $3.19 in the December contract. Soybeans and January contract, nose expired today. Jan's became the lead month. We actually closed down just shy of 15 cents on the week at $10.22. Wheat was a big winner this week, up almost 46 cents this week in the December contract at $5.60, a little over $5.60 on the close. Cattle and hogs were stronger this week as well. The December cattle contract closed up $3.40 at $170.20, contract highs. Lean hogs were strong as well, up $3.90 in the December contract at $92.67. Taking a look at the grain markets this week, the major fundamental news, the primary fundamental news this week was the monthly supply and demand report. The trade was wondering how large crop the USDA was going to give us and how we were going to offset that on the demand side of the equation. And just taking a look at the numbers, the carry out for the week for the report was unchanged for both corn and beans. Slightly smaller in corn, but basically unchanged. The trade was actually looking for an increase in ending stock. So we ended the week, the report stated just a hair over 2 billion bushel carryout. We were looking for a 2.135 billion bushel carryout. The trade reacted accordingly and did see a little strength on Monday upon the release of the report at 11 o'clock. Soybeans, we were looking for a small decrease in carryout down around that 442 million. We left it unchanged at 450 million, and beans sold off accordingly, about what one would expect from the average trade guess going into the report. But the fireworks were set to come later in the week. We've seen a lot of volatility as we move through the week. To get back to where we did see those numbers, we did see the corn yield drop. Not quite a bushel, about 0.8 of a bushel at 173.4 bushels an acre. That would have been the shock in the report. We did reduce production 68 million left acres alone. There was some whispers that we could see some acre changes. Those were left alone. And the demand side of the equation was basically left alone to give that carryout virtually an unchanged look. Soybean yield was larger as expected, but was offset by export demand. We didn't see the biggest increase that we were hoping, or some were hoping to see in the demand as far as exports on the balance sheet. We increased our yield about a half a bushel an acre to 47.5 bushels in soybeans, up from 47.1. So when it was all said and done again, the trade traded accordingly to what the carryout numbers were expecting. But then we did see some volatility, especially the soybean market and the soybean meal market. Soybean meal shortage pipeline needs to fill up story is still in play out there. And we did see some explosive buying as soybean meal did make new contract highs this week, as well as soybeans did nearby highs in the January contract. We did see quite a range, 66-cent trading range on the week, 53 cents on Tuesday, 42 cents on Wednesday, 33 cents today. Most of that was to the down, unfortunately, closing lower for the week. So hard to believe now we've had 2 weekly closes lower in soybeans with new nearby highs in the January contract. So a lot of volatility out there. We've seen about a 45-cent move on Wednesday alone. It was 42 cents on Wednesday alone, and that was in a matter of just a few minutes. As the concerns are filling the pipeline up here, crushers are making very good profits. Soybeans are cheap compared to meal. There was stories that we're importing soybean meal now. A major feeder in the southeast part of the country was importing meal from Argentina, and on paper it works. Now this is yet to be confirmed, but if confirmed, it would suggest that either we are overvalued here in the U.S. or South America is undervalued. Needless to say, that poured a lot of cold water on the explosiveness of the upside on the soybean futures, and we were able to sell them off in a hard, quick turn down. And again, that was on Wednesday of this week. So we did see a lot of volatility. Technically, it's still an uptrending market in the monthly contracts, but from a weekly perspective, the hedge funds, which have been large buyers in here this week for both corn and soybeans, the question is, at what point do they want to continue to add to these positions, or are they looking for an exit point? 2 weekly down closes in beans may weigh a little bit on their decision, something to keep an eye on next week. Certainly, we've seen the last 5 weeks where we've seen explosiveness at the beginning of the week, only to see a little bit of weakness. This past week being the exception due prior to the report. Corn market more or less followed along. At one point when we were up earlier this week, up 40-some cents, I believe it was on Tuesday of this week, corn was up only a penny and a half. All the excitement again was in the soybean and soybean meal contracts. Corn did push higher due to the spillover strength in the soybeans, and it did attract some fund buying as corn was viewed undervalued in relationship, and also technically we're able to take out some nearby contract highs in December corn as well. And then corn may have been beneficial or been helped out by the wheat contract, which scored contract highs as well. Some concerns out there about the too cold, too quick for wheat. It's usually a short-term play for strength in the wheat market if that is the case. Also concerns about what was going on in Europe with Putin putting troops and tanks back in the Ukraine, so there's some concerns there as well. So wheat did close on a very strong note this week. As we move forward, the thing to keep an eye on is basis. The soybean market is the direction, I do believe, is going to still be basis in the meal. As soon as the meal buyers back off, I would suspect you'll see the basis back off on soybeans as well. I think that'll be the leading indicator for the grain markets, including corn, as most farmers are finishing up harvest. Everything is in the bin at this point. It might be tough to get it out of the bin prior to the end of the year, as thoughts are that the farmer as a whole is virtually all right as far as cash needs for this year, but as he moves into the beginning of the next year, things could be a little bit different. Taking a look at the cattle markets, hog markets, livestock futures. Cattle futures are able to print contract highs this week and close near its highs this week in every month through December next year, this December through next December. Cash trade this week was fairly light. There was some very light 170-71 cash trade in Iowa due to a new packing plant opening up. But beyond that, very little cash trade that we're aware of at this point. We're suspecting that there will be some done here yet this afternoon, may give us direction come Monday morning. So once we were able to take out the contract highs in the middle of the week, we did see open interest jump. Open interest yesterday actually jumped 10,000 contracts in cattle, suggesting we're seeing some new investment money coming into the cattle market. Boxes were a little stronger on the week. We're still in the choice contract, still $8 underneath the highs. So even though we do have the futures running up hard up here, the boxes are not coming up, suggesting the packer is getting squeezed on margins, and he's going to either have to buy cash cattle cheaper or he's going to have to print those boxes higher. The number of negotiated cattle out there is tough to tell at this point. There's a lot of contract cattle coming in. That's where the largest volume of the kills are, even though the negotiated price seems to be running the futures right now. So Take a look at that as we move into next week about getting some hedges made out in that April contract. Testing that 170, we were unable to take it out, but certainly an excellent opportunity to lock in some protection. Hog futures this week were able to break out of their sideways choppy trading pattern. Cash wasn't really the leader to the upside this week. Futures may have been supported by export sales, which showed a big uptick this week. Primarily China was in buying hogs, so we may see a little bit of strength there on exports. May have been able to propel the futures. We'll see what the cash trend continues next week. Take a look at rallies as a selling opportunity here as well, as we are still seeing very large weights and numbers up. If you have any questions, I guess, feel free to give us a call here at BIS Commodities at 1-800-373-2525, or check us out on the web at biscommodities.com.